Michael, I'll start off with you first. Why this feeder fund looking to invest in European markets?
Well, it's a good question. So the objective is to give Indian investors the exposure to the European economy. As you know, Europe is a big part of the world's stock market. It's roughly 25% of the world's stock market. It's actually also, if you look at it in terms of GDP terms, it's actually the largest region of the world if you add together the aggregate countries. It has over 17 trillion US dollars of GDP. So from a global investment point of view, it's actually very hard to ignore the European market. And we think that Indian investors in their global diversified portfolio should have some exposure to Europe. So that's really the reason why Franklin Templeton are launching this feeder fund at this point in time.
Michael, afternoon. So the question remains, is the worst then for the European markets over?
Yeah, we think the worst is over. I mean, we're still depending which country you look at, there's countries which are improving their fiscal situation. There's lots of labour reforms going on. But in aggregate, and when you look across the various economic indicators, what we see is that the worst is definitely being passed. And actually, most of the economic indicators you can look at are actually showing a positive upward trend. And that's translated through, importantly for me as a bottom-up stock picker, as a fund manager. When I look at what that means for the individual companies, it means that it's a good backdrop for the average European company to be operating in. Profits are going up, revenues are going up, and yet the valuations still haven't caught up with that improved underlying picture, we think.
Vivek, I'd like to come to you now because we talk about the domestic retail participation in the equity markets, and that of late, no doubt, has been rather subdued. In fact, DIIs have pulled out over 4,000 crores, while you have the FIIs which have invested something like 4,000 crores within the same period. Do you see retail investors returning to the equity markets, or will this trend of booking out of investments as markets trade at record levels going to continue?
No, you see, I think investors pulling out, retail investors and domestic investors, I think has got a little bit to do with the fact that a lot of investors got into the market at a peak in 2007, 2008, and they are now, they got burnt. And if you actually look at the equity markets since 2007, it's only in 2013 that they crossed the levels that they were at 2007 December. So I think there's a little bit of an hangover from that. I think from a long-term perspective, I think investors, retail investors will continue to invest in the Indian markets. Penetration levels are low. Investor awareness is low. And I think all of that is changing. SEBI has come up with a lot of initiatives for the fund industry to actually go to the smaller towns, increase investor awareness. There's 2 basis points of our AUM now is set aside for investor education. So a lot of steps are being taken by the industry, and I think that will bear fruit. As regarding and what was your second question? It was on the market levels, right? Yeah, so I think that, even at current market levels, if you look at the 1-year forward price to earnings multiple is, somewhere between 15.5 and 16. If you go back to 2007, December, 2008, January, those levels were in excess of 20. So, in a relative sense, valuations are not stretched right now. So I think there is room for the market, to further appreciate. It'll all some of it will depend on the elections. If you have a stable government, then I think one can expect to see the markets rallying.
Vivek, the follow-up then, industrial stocks from engineering, chemicals, construction have been a big area of focus for you. How do you see a decisive government in the sector impacting the future potential of these stocks?
See, I don't think, the governments can have just the change of a government can have an impact on individual stocks. I think what needs to happen is policies need to change. And when policies change, if the market views those policies as being conducive to business, then those sectors and those stocks actually rally. We tend to look at it from a slightly longer term perspective, and our 2 themes for India are really consumption and investment. And we believe those themes remain intact. India needs, there's going to be consumption, and there's going to be, India needs investment. So those themes are very relevant. And we believe that, companies that operate in those to those themes will actually do well. So banks, consumer industries, in infrastructure, I think they will all do well in the long term.
So then I want to break it down to sectors, Vivek. Where is it that you think that sectors appear expensive, and what about the areas in which you are seeing value currently?
So I think the sectors, I think consumer stocks and I think banks, have kind of moved up. But there are other sectors, I think, cyclical and rate sensitive stocks have all moved up in the last, few months. And I think there are several sectors, that will continue to do well. I think telecom, I think auto, I think they will continue to do well going forward.
Okay. And Michael, a lot of money is flowing into emerging markets of late. Does this change at all, or does it stay the same for the next 6 months?
Yeah, we think so. I mean, if you look at the European market, the share prices have come up in value over the last 2-3 years. But that's been really against a backdrop of improved macroeconomic fundamentals in Europe. So after the financial crisis, as you know, many companies cut their costs. And at the macroeconomic level, what we're seeing now is an improvement. We're seeing GDP forecasts improve, sentiment indicators improve, unemployment stabilising. And so actually the fundamentals behind the European economies are improving. And so we think that if you're investing in Europe right now, you've got a tailwind behind you of positive macroeconomic news. And then when you compare that to the valuations you get in the European stock market today, we still think it's quite attractive. For example, if you look at the European market in aggregate, you can buy the European market on a roughly a 10% discount to the US market. So we think for overseas investors, today is actually a very attractive time to get invested into the European market.